Cem Karsan is back and with receipts. Can't wait to dive into what he's been saying about the past and what he's predicting for the future. And Fannie Mae and Freddie Mac compelled to accept crypto or to consider crypto if you want to get a mortgage. Wow, you will take crypto or you will suffer. All that and more on today's After Hours.
That was an aggressive opening. I liked it. Very forceful.
Welcome to After Hours, a Traders Post for Friday, June 27th, 2025. I'm one of your hosts, Tom Hartman, joined tonight by Peter Bad Guru Hartman to break down the market madness. And what a week it's been. It seems like every week, Peter, that passes is even more crazy than it was before. And when it's not a crazy week, something's crazy that we just didn't figure out. We just didn't realize what was going on. But I'm happy because Cem Karsan is back out of the woodwork.
You and Cem Karsan.
I don't know where he was. Hey. If somebody is making path-dependent predictions and it's helping me make money and they're right consistently, I'm going to talk about it. People will talk about the RSI all the time. Cem Karsan's righter than an RSI. He's the best indicator there is. And we should lift him up, prop him up. We should praise him because the more we like Cem Karsan and say good things about him, the more he will bless us with his blessing.
Isn't there something that happens in the summer with vacations and stuff in the market?
Okay, Peter, you're called Bad Guru because you're not a really good guru when it comes to stock market. Okay, so
I've never claimed to be.
It's just when you start saying things like, "Hey, isn't this what normally happens?" and you're talking about seasonality and flows and all that.
Hey, you asked me to be here.
Leave that stuff for me. All right, leave that to me and my buddy Cem Karsan and Darius Dale and all that stuff. Okay, you're here to look pretty. So you're going to sit there and look pretty because I don't want the right side of the screen to be all empty. That's what you're here for.
Look, I could just
for some reason you're all purple. Wait, we could have done this the entire time.
I don't know why I'm purple. I got to fix this thing. It was fine, and then
It's fine. You look terrible in the normal circumstances, so don't worry about it. Okay, Peter, I'm very excited because there's been actually a lot of movement that's happened over the last week. We had Iran bombed by Israel.
Where?
And then Iran was bombed by Israel, and then the United States, and then ceasefire within 24 hours.
Did the ceasefire actually happen? I heard it was happening.
I don't know. I assume so. Stock market's not down, so I assume the ceasefire went through.
Mm-hmm.
That's how I judge everything. I find out about the news when the market moves.
I'm curious if you're going to talk about anything with China, because I hear there's rumblings that there's going to be a tariff deal with China coming soon.
Nothing is, if it doesn't show up on the charts, I care not at all.
I don't know if it showed up on the charts, so I'm asking you. You're the chart guy.
Yeah, not at all. I want to know what the trade is. Right? We're here, guys. After Hours is the Traders Post market commentary show because people using the Traders Post platform are great at executing their trades. Right? Some say that Traders Post is the best automated trading platform in the universe, and I have to agree.
Yeah, of course you have.
My unbiased opinion is that I agree. But sometimes the difficulty that people have is in finding the trade, figuring out what to pay attention to, what markets to deal with, what time horizons to play in, and that sort of thing. Now, if you're going to be scalping and you're going to be doing swing trading or whatever, you don't need this. I get it. You don't need this. You're busy on your 1 minute, 5 minute chart, and what happens on the grand scheme of things doesn't matter to you. But if you want to make real money, I'm kidding. I'm joking. Prop firms have changed the game for you folks. You're able to take your tiny little nothing trade and spread it out across 20 different accounts. Now you're hot stuff. I like it. It's great.
So, are you trying to make enemies?
But if you care about geopolitics, liquidity flows, market structures, inflation regimes, monetary and fiscal policy, big brain stuff. That's what you come to After Hours for.
Oh, that's
That's
pretty
why you're
good.
here.
That's why we're here.
That's why you're here.
I mean, I care about that stuff. That stuff seems relevant. At the very least, it's entertaining. Look, I watched all this market commentary stuff. I watch it. I look at the markets, but it's not because I'm like super invested in the markets. I just find it, if I'm going to be entertained by something, look, the markets are my reality TV show. All right. Reality TV shows,
That's
they're all
right.
fake, but the market is the realest thing. The market is realer than a conversation with my partner. All right. Her, I got to like figure out like what's really, the markets are like, this is what's happening. Love it.
That's absolutely true. In fact, I like that you mentioned it that way, because when I used to watch American Idol, or you're watching Big Brother or whatever, I don't even know if my vote's going through.
That's right.
But in the markets, there's no fudging it. Retail flows, institutional flows, pension funds, sovereign wealth funds, what the Forex is doing, they can't manipulate it at all. It's a $125 trillion market worldwide. And so that's why I like the markets. The markets are just like the stars in heaven, just like the planets. And in the same way, astrology allows you to properly predict what's going to happen to you and your loved ones in the future with pinpoint precision accuracy. So does the market for us regular folks.
You're right. Right.
It's science. It's and some might say, well, I was going to make the claim that you can actually trade the stock market. I was going to joke that you could trade the stock market just based off astrology, and you'll be just as successful. I was going to be tongue in cheek, and then I realized, no, you actually can do that, and you could just be just as successful.
Didn't you do a blueprint episode about astrology?
That's right. In fact, that's not even half of it. My wife, who's very big on astrology, and I would never really like show this on stream because it's just going too far. We've met, retrogrades and planets on different houses, and make predictions of what's going to happen on charts. And
it's great.
It's better than many indicators. So I don't know what to tell you.
She's the only person I would trust on this stuff for sure.
Well, I didn't think the moon could really help predict what would happen with markets, because the moon is hollow and made by aliens in order to terraform the earth.
Oh, well, is this a Joe Rogan podcast all of a sudden?
No. Dragons aren't real. Okay, dragons aren't real. That's not a Joe Rogan podcast. So I didn't think that this, man-made object or alien-made object could have anything to do with us, but apparently it does.
Well, didn't we see a chart that mapped like the lunar cycles to Bitcoin or something?
Correct.
Was that real? Or I remember
sell on new moon, buy on full moon. It's
Mike was
buy into the full moon. Sell. Well, this is what I'm saying, Peter. It was a joke I was going to make, and then I realized it's truer than anything else. Okay. We've watched, if you've watched After Hours, you know that we care quite a bit about liquidity flows. Why? Because of our buddy Cem Karsan, who has taught us about this. If somebody else taught us about it, Michael Howell, very big at teaching about liquidity flows. And in general, Jeff Snyder from Eurodollar University. So Michael Howell is from Cross Border Capital. Great follow on Twitter. Eurodollar University. You also get big picture stuff. Jeff Snyder, not particularly good in the week by week, quarter by quarter thing, but great for education and understanding how the Eurodollar system works. But the flows of dollars in the system is what matters. If you're sitting there wondering, how could it be that Iran gets bombed, assets drop, and then V's right back up as if the market's like, okay.
S&P hit a all-time high, right?
All-time high. S&P and NASDAQ, all-time high.
It's just crazy. I mean, I don't understand. A little while ago, the sky was falling. The towers.
You're right. You don't understand. Correct. Please don't interrupt me when I'm speaking. COVID falls, right? And if you're like me, you shorted, thinking the world's locked down.
Is it?
Obviously, this has to be the worst thing that's ever happened. Short it to zero. Nope. All-time highs in 2 months, 3 months. Face ripping rallies. GameStop, AMC, the whole thing. Bitcoin at 69,000. The market. This Jonathan Wage, CEO of Traders Post, loves to say this inside of our Slack channel all the time, every day, all the time. Markets only go up. Stop it with your analysis. Stop it with your technical analysis. Markets only go up.
Are we supposed to call him Jonathan? Because I haven't been doing that.
I call him T-Money.
T-Money. I like that. I'm not going to do
money.
that. Markets go up.
Markets only go up. Totally understand. And false prophet Peter Schiff has been wrong 20 years.
He's been right twice in those 20 years when it really matters.
Right. That's the same thing as being wrong 20 years.
And gold is pretty. Isn't gold like just keeps climbing?
Gold's falling. Gold's garbage. It's not garbage. It's not garbage. It's a great asset. Central banks want it. They hold it. It's a great asset. Okay, back to what I was saying. Cem Karsan taught us about liquidity flows along with those other people I mentioned. Great follows. Go check them out. Tell them Tom sent you. Tell them Trader Expo sent you. Because I'd love to get them on the show. In fact, if you just pester them constantly, if you just message them all the time, hey, when are you going to be on Trader Expo? Aren't you on Trader Expo? I thought you were somebody. Get on Trader Expo. Get on after hours. We want you here. But until then, I'm going to stalk them online and consume all the content that they create. And so I'm going to start off first with we're going to end on Cem Karsan, but we're going to start off on Darius Dale, who runs 42 Macro, great research facility, democratizing institutional content. And I like Darius a lot. Small problem with Darius. Tiny problem, Darius. Tiny problem. Very big brained. Lots of talking. Smaller sentences. Bite size. Bird brain.
That's a good rule of thumb for just public speaking in general. Even I have to learn how to do this and keep practicing. Keep your sentences short, your ideas short. We live in a TikTok world.
He's too smart. He's too smart. And he talks and you're like, sometimes you have to it's like reading Dostoevsky or something like that. You have to write down what he says and then you have to go and like AI every line just to make sure you understand, you can follow the context. I want 48 laws of power. Come on, just give it to me. Spoon feed it to me.
Hey, that reminds me. I haven't, but I should AI summarize Nietzsche or something like. I don't know anything about what these guys have been talking about.
Not surprising. Let's get to the video. So Darius Dale was on, did an interview 5 days ago on the Thoughtful Money podcast from Adam Taggart. An hour and 15, great listen. Definitely go check it out. You really want to be absorbed inside of this, the macro and fundamental analysis, because it helps explain a bunch of movements that happen inside of the charts. It's sort of like farming, and you're trying to farm, but you don't know anything about seasons. It's like you're gonna have some rough months there. So it's very, very useful to pay attention to weather in. All right, so let's see what he has to say over here. There's two things I wanted to bring up.
Okay, it's great every time I talk to you about the model.
One more time. Can you hear the YouTube video?
Yeah.
Itself, Darius, I feel like it's just this infinite onion that I always feel like I understand it a lot, but I always learn more about it than with each time that you're on, and have an increased appreciation for it. Okay, so that's the model. Let's get to the data.
Sure.
I mean, there's a lot going on in the world right now. We certainly have all this geopolitical instability
via these products, and that's why KISS exists, is percent relative to a naked long portfolio of stocks, gold, and Bitcoin. Than you would if you just dirty little secret, which is that asset value. It's going to happen to your portfolio.
So he's just talking about the idea of how he constructs his
Hang
portfolio.
on. Let's do a clean start because I got to cut this up. Let's do a clean start.
All right. So Darius here is going to be talking about, in this video, he talks about why he even bothers with a model. Why not just buy the S&P and just write it up?
Right. And
he talks about this idea that what you want to do is grab 80 to 90% of the move up, and you're going to get some drawdown. But if you only have, let's say, 50% of that drawdown, then you start compounding your wealth faster than if you just held through the entire cycle. And he's going to talk about here this, because he used to work with institutional clients, or he still does, but he used to work inside of the institutions, and he talks about their dirty little secret.
Shaded boxes and stack them up together over time. What's going to happen to your portfolio is you're going to wind up compounding returns from a higher net asset value in every subsequent market cycle than you would if you just hodled all the way down to the lows. And so this is the secret. This is Wall Street's dirty little secret, which is they sell you products that force you to onboard volatility drag into your portfolio, target date funds, pie chart asset allocations, all this boring manila nonsensical stuff that's quote unquote safe. But the reality is you're just providing liquidity to the strategies that they use to avoid the volatility drag they're selling you. via these
Wow.
products. And that's why KISS exists, is to give people a life raft to stop that process and really speed up their, their on time and comfortable retirements.
So I love Darius. He's absolutely fantastic. For years, I followed him just to understand the how inflation and growth within the economy and within financial assets affects the policies for monetary policy and fiscal policy, and how you can use that to predict what might happen. He's not the only one who talks about that, but he's the one I followed for that. Fantastic. And that idea here that the system is set up in such a way as to take agency away from you, you go trust other things with your money, and then there's an incentive for those institutions or those businesses or whatever you're dealing with to make it so that you're exit liquidity for institutional players. All right, so that to me is just unbelievable. Which is another thing for I like to plug Traders Post here, because I think the idea of Traders Post provides you with automated trading in the sense that it helps you connect your trades to your brokerage account, and your crypto exchanges. But it's more than just that. It's the idea that you should be empowered to be able to do these things, right? You should be able to manage your money, create your own indexes, your own portfolios, balance what your risk is, make changes over time, and have the financial wherewithal, the knowledge to be able to do it. Like, it encourages you, hey, this tool exists. Let me learn what's necessary in order to take advantage of it. And when you follow people like Darius, like Cem, or what have you, you end up with a greater understanding that allows you to navigate what you're doing better. And then you feel more in control of your own existence, your own financial future. And you can, work towards retirement as opposed to sitting there with your 401k, hoping that everything is going to go well.
And
I love that.
Just to piggyback on that just a little bit, I think of Traders Post as a force multiplier, right? At first I thought, okay, it takes my trade order, it sends a signal to the broker. But the fact that it can amplify what you're doing, right, across different assets, across different things, and makes it more efficient, so that my time is better served, so I can study and understand what the markets are doing. Having Traders Post as a tool in your tool belt just amplifies your ability to take advantage of these markets. And we got to appreciate the fact that we're in a predatory environment, like what he's talking about. There's all these things set up to disadvantage you. You want every advantage you can have, and Traders Post is that advantage.
Yeah. If you take a look at, for that first multiplier, if you take a look at some of the Mike Christensen interviews for Trading Bot sessions, so we had one before with a Tyler Goodell, who was like in construction or elevator repair, who takes his life and turns it into making six figures because he learned how to read markets and manage markets and trade markets. And then so he ended up doing that, getting out of the rut that he was in. Young guy. Then you have someone like Rebecca Trades, who stay-at-home mom, who found a way of doing this while raising her family, making money there. Great follow on Twitter as well. They're able to daisy chain their accounts using Traders Posts to trade prop firm account across multiple different prop firms. And so one trade that might have been, net them $100 in a particular situation now could be multiplied out. So now they're making $2,000 for that same idea, that force multiplier idea. Then you have Farming Features, John, who's a farmer. I mean, you go see him on the farm there just toiling around, talking about the trades he's making. And you're like, that to me, it feels like Clark Kent and Superman. Like, this guy just mild-mannered, making money on there, just casually talking about the money he's made. And then just the other day we had, not going to spoil it completely, I don't think the video's out yet, but I said somebody else who's using the financial markets in order to
you can't spell the B's.
fund, who are able to fund his what he wants to do in order to be a positive force within his community. Market education to me is like, you do not want to delegate it to a money manager or a financial firm. It's not like an accountant. It's not like your mechanic. You having control over this really gives you a knowledge to what the heck is going on, what's true, what's not, what matters, what doesn't.
You know what I find funny? What I enjoy, especially with Tyler and Rebecca, once they're explained what Trader's Post does, because these guys are making money doing prop
Yeah.
firm, right? I watch them on camera. You can see the interviews on the Trader's Post YouTube channel. Like and subscribe for the next one coming up. It's a really good one. When they realize, wait, what can I do with Trader's Post? I think Rebecca was saying, why aren't you guys yelling from the rooftops like this is amazing what you can do? And we're like, look, we're trying to get the word out here. But once it clicks, wait, I can have superpowers doing my prop firm thing. It's so much fun, and I actually want to be a part of helping other people to realize that, to understand that, because I mean, look, we're getting this market news, you're learning how to do indicators and all this cool stuff with AI. Man, you got to put that into practice, get some profit from that.
That's the prop firm side, right? But then there's the side that I enjoy. Like, to me, I find the prop firm stuff fascinating, but the stuff I really enjoy are macro strategies. I love the idea. My favorite trades take 6 months to 2 years to play out and can yield like significant amounts of money with, for me, a lot less stress. And when you're paying attention to stuff like Darius Dale, Cem Karsan, and what have you, and they have either the information they provide or the tool set that they give you access to, I'm able to develop strategies that are taking what Jerome Powell is saying, what sentiment that's happening on Twitter or whatever, build that into a strategy that I can then automate in order to turn my knowledge of markets and news and how they affect the different aspects of government and the financial system to my benefit. And I just find it to be so satisfying. So anyway, so that's why we're talking about Darius Dale over here. So here he talked about that dirty secret that you can be, I don't know the ins and outs of it, but the idea that retail traders are used as exit liquidity for institutions is common. We all know this. All right, the last thing I wanted to talk about here is that Darius does see some upside risk, right? So the risk is to the upside. So if you're short here, he's like, hey, be careful. That might not be the best thing. So let's take a look what he has to say.
Where do you think the risk is on economic growth? More to the upside for the reasons you just mentioned, or more to the downside?
Yeah, in our view, it's highly likely to be more to the upside. So for starters, our grid model, which is a better track record of predicting growth from a first different standpoint than Bloomberg consensus, which again, this is a lot.
The grid model is the growth, reflation, inflation, deflation, the 4 quadrants of the 4 seasons of markets.
No, I don't want to say that, but never mind. It's a slightly better track record of predicting the first difference in growth than Bloomberg consensus, in our opinion. That's one starting point. So we would never base a fundamental research theme on a model-based conclusion. All of our fundamental research themes are based on first principles relationships in the economy that we identify faster than other investors.
Does that mean anything to you, Peter? First principles associations within the economy that they identify faster than other market participants?
Being closer to the exchange? No, that can't be it.
No, exactly. It just means that they're analyzing the components of the economy and the markets in order to predict what will happen with their derivatives afterwards. So they don't wait till a news headline happens to find out what the jobs report is. They go and find out, well, what's going on the street level, right, to be able to predict that the report will say that the jobs will be up or down.
Right.
One relationship in the economy that we've identified, or at least one thing that we think is likely to be very impactful for the financial markets, is the fact that consensus currently has this very elevated implied recession probability. Currently, it's currently at 40%. It was at 20% to start the year. It typically hangs out around 10 to 15%. So essentially, the consensus implied recession probability could get cut in half twice to get to a normal level. So let's ask ourselves, why is it at such a high level, and why do we think growth could potentially surprise to the upside over the medium term? Right now, there's a tremendous amount of
tariff concern. Yeah,
concern, and there's a tremendous amount of uncertainty with regards to the future policy outlook. Yeah. And this is reflected in the Baker-Blumen-Davis index. We're essentially at an all-time high as we were at the height of the GFC, as high as we were at the height of COVID, currently right now, and have been there for a couple of months. So obviously that's applying downward pressure on the economy.
So you understand that the idea is that the sentiment of the players who are positioned within the market is negative. They have a 40% implied recession, which means that their position and their behavior is that, which means they're on one side of the boat. And we all know what trading is. It's be on the side of the boat that the people aren't on. So as the trend goes in one direction, when it changes, all those people have to change their positioning. Right? If you're short, now you got to go long because you got to buy back your shorts. If you're long, you got to go short. And so he's saying, hey, the market's moving up as 40% of the market participants, major market participants, think that recession is incoming. Well, the pain trade is for them to be wrong and for the risk to be the upside where the market moves up, and they're forced to buy in, which could cause blow off tops.
I like the sound of that.
The risk that investors are missing is that
not that it will cause a blow off tops, but just that mechanism of as people are forced, right? There's discretionary players, and then there's people who are forced. They have to cover their positions, or they have to sell their positions.
Mm-hmm.
This at some point policy will become more clear and less certain. And I think there's a large I don't think we can observe this in our positioning model with empirical time series. We can very clearly see that investor consensus is not fully positioned for policy uncertainty resolving with good policy.
Right. And sorry, you said more clear and less certain, but you meant more clear and more certain.
Sorry,
right?
yeah, my apologies. Thank you.
No worries.
You hear what he says there? He goes, what people aren't positioned for is that policy gets resolved, tariff-wise, world-wise, whatever, and that it's good. That what it gets resolved to is a good thing, not World War III. Good economy, good growth, high productivity.
Well, if you don't
that
have,
would be the worst trade for the market participants.
well, if you don't have first principles thinking on this, and you're paying attention to the headlines, I'm not surprised. I mean, if the headlines that I kept seeing is Donald Trump is causing a disaster, everything is the worst it's ever been, and nothing's going to work out, nor could it. And I don't know. I mean, I don't know what's true. I'm not like these people with my finger in the data. I don't know what that means.
Well, that's why it's called upside risk, right? You're normally still hearing downside risk. Things could fall. Well, if you're positioned for things to fall and they don't fall, it's the same thing.
That's interesting.
All right. So go take a look at the full video. I mean, I could watch this all day long. I'll put the video inside of the description. So you guys go check it out. But absolutely fantastic. Love Darius Dale. All right. Let's switch gears to Cem Karsan. Also fantastic. And let's see what he has to say. So a couple of things I want to touch on. All right. There's going to be quite a bit of meat here. Let me just switch this. And I want to show this because it is important to me that people, it's important to have people to pay attention to. There are people who have access to data that you don't have access to resources you don't have access to. And what I find is useful for us as retail traders is to be able to discern the people who have a good track record, who have access to information that we don't have access to, and can articulate that idea to you. So even if you disagree with them, they're your indicator. They're one of the indicators you're using, which I find funny. People will be like, oh, you listen to a guru or influencer. You're listening to MACD and RSI trying to make decisions. I don't understand how that's any different. Mine is far more reliable because his reputation's on the line. All right. So this first part here, Cem is going to be talking about. He's on the Stock Twits podcast 7 days ago, and they're talking about the idea of who's going to be Fed chair. Because remember, Donald Trump wants interest rates to be lowered. Why? That releases capital or reduces flows within the markets, and stock market goes up. Bitcoin goes up. Jerome Powell is not cutting rates. So the idea is his term is going to be up soon. Who is Donald Trump going to choose as a replacement?
You know when his term is up?
I can't remember. I think it's by the end of this year or 2026, something like that. 2025, 2026. And Donald Trump floated out, I think. Did he float out? That
May
he should
2026.
That he should be Fed chair.
Who?
That Donald Trump should be Fed chair. It was a joke. I think he floated this out. Let's see what he has to say.
And so that's actually driving more of the action. The index is itself in the single name. So it's really a push-pull between the two. And this is kind of a great example. So anyway, Summer of George is also a time of massive dispersion, as you highlighted 2017, and that's another big thing to think about.
The more you talk about this, the more it just feels like there's a select few at the top who've kind of figured out some sort of infinite money glitch, where they realize that they have so much power and so much influence via these the options mechanism at play with the vol compression and all that stuff, and they can just sell all these massive swaths of options, knowing full well that it's just so big that the market can't possibly budge in the face of it. And it's just, they collect the premium. They figured out just week after week, month after month, quarter after quarter, how to do this until you have those tail risk moments where it all can blow up in their faces. But I mean, can you speak to that when you hear about like JP Morgan's trading desk just having record profits?
Okay, so just listen to what's coming up over here, right? So the guy just laid out. It feels like it's just an infinite money glitch,
Isn't it?
Well, he says until they get blown up. So it's picking up nickels in front of a steamroller until you get crushed, but it's not even nickels because they're making oodles of money. And he goes, it just seems like it's all rigged, right? And Cem has a response to this.
It's not a conspiracy. I don't want to make it sound like that. What it is there are probabilities, if you understand something well, where you can make more money because you understand it better than others. Yeah. And you better believe, if you can.
Or as they say in the 48 Laws of Power, the eagle, the bird of prey who eats the sheep, doesn't hold any grudge against the sheep. The sheep hate the bird of prey. The bird of prey loves the sheep. It's not a conspiracy. That's just the way things are.
It's something way worse than a conspiracy. It's human nature.
It's just the way the things are. All right, let's go back to it.
And that people are going to do it. That's just business, right? That's free market. That's the free market. So
it's pragmatic.
Yes. Understanding options and the importance of it. That's part of what we're trying to democratize here.
Yeah.
The reality is that most people still think about markets in two dimensions, like they're just stocks. And
okay, that's my mistake. I played the wrong section. That was infinite money glitch. Let's go to the Chairman Trump one.
He's volatile.
Yeah, he thinks that.
His hat says "Make volatility great again." Let's just be clear on that one.
I love that. Look, I want to get a hat like that, but I can't walk around with a red hat. I don't think I can wear a red hat anymore.
He's volatile.
Yeah, he thinks that. I don't know what to think of whenever Trump says stupid garbage like this, but he's now saying, hey, maybe I should be in charge of the Fed. Maybe I should be the one calling the shots.
Yeah, do you think he should appoint himself? He said maybe he'll appoint himself. I think maybe he's looking into the legality of that.
Well, the reality is that Richard Nixon appointed Arthur Burns, who was his long friend.
Way better way to do it.
The conversation turning to Bessent potentially being the Fed chair makes a ton of sense. It is, quote unquote, an independent entity. So once they are appointed, Trump loses control of that other entity. And so he wants more than anything. The reason him saying psychologically, like, maybe I should appoint myself, is he knows he needs to find the person he can most trust. He doesn't feel like he can really trust anybody in this to do this most important thing, which is control the Federal Reserve. So when he says that, what he's saying is, I got to find, who do I choose? Because I lose control the second I appoint somebody. It's got to be somebody who's going to do my bidding.
Who do you think he's going to, for the next year when Powell's time is up, who do you think he's going to go for? Weren't there rumblings that it was going to be Scott Bessent?
Yeah, I think it is.
That's what Cem just said.
Yeah. And that's why, because it's the one person he's gotten comfortable enough with that he feels like he can trust. I would
take your poly market bet if you're interested. Take your poly market bet on who's going to be Fed chair.
But this is a year from now, no?
Yeah. So
that's crazy. Scott Bessent could be. Does Donald Trump have a choice? Like, how does the Fed chair get appointed by the president?
Well, he appoints them, then they get vetted by confirmed by the House, and then they go through. But it's like, if RFK and Tulsi Gabbard go through, I think Scott Bessent's gonna be fine.
Shock me if like his, if it's one of his sons or like somebody. Like, my point is that he wants to find somebody that he can know absolutely when push comes to shove that they are going to do his bidding.
And Eric Trump, head of the Fed, is a fun image for me.
Exactly. That we should play around with that. That could be one of the memes here that comes out of this. But the reality is, he is. If he wasn't subject to the bond market freaking out, right, to him choosing somebody who doesn't make any sense, he would gladly choose whoever he feels he can control in that situation. It makes sense politically. This is not a political comment. Like, the reality is, it's the most powerful position in the world. It's more powerful, I'd argue, than the president of the United States.
Mm-hmm.
Let's just play that back.
Situation. It makes sense politically. This is not a political comment. Like, the reality is, it's the most powerful position in the world. It's more powerful, I'd argue, than the president of the United States.
Mm-hmm.
He wants that lever of power.
So you gotta know, you gotta understand, the monetary flows, that's what controls the markets. Fiscal flows can affect the economy, can affect inflation, stuff like that. Monetary policy is the regime you live under. Okay? Your regime, your 80 years of life is a series of monetary policies. Do not think, look, yeah, I know you want to think your vote matters, and it does matter.
I was just about to say the same thing.
It does matter. But there's a reason why every month or every Fed thing, people are scrambling around to figure out what words were changed inside of the press release from the Federal Reserve and what minutes were released 60 days ago to see what was said inside of there. And does Jerome Powell look like nervous or not nervous when he's on stage? And not just him, but Yellen before and Bernanke and Greenspan and all that. There's a reason why that happens. And Donald Trump will talk. You don't even know Donald Trump said anything.
Yeah, we know every syllable.
Yeah, you don't even know. Oh, I guess Donald Trump did something. Oh, he threatened the country? I guess. All right. But Jerome Powell, they know if he used the word with or and. Okay? All right.
Okay. I'm laughing, but it's kind of terrifying at the same time.
No.
We don't vote for the Fed chair.
Voting. You don't vote who's going to be the CEO of Apple either. It doesn't stop you from buying the products. Voting. Come on. It's not even a national holiday, Peter. Come on.
It should be.
It's not even. Half the people don't do it. More people buy Valentine's Day gifts than vote. Come on. Voting. Voting's important. Do your duty as a good citizen. But no, voting's stupid, and it's more about the policy, what you spend your money on. That's what actually matters. Like, stupid, don't vote. Don't bother. Why
No,
bother
you should
voting?
definitely vote.
No, vote. No,
vote.
you should definitely vote.
You should
No,
definitely
sorry. Let me phrase it. You should definitely vote, but your vote doesn't matter.
It does matter because the president appoints
doesn't
the Fed
even
chair.
a little bit
The
matter.
president appoints the Fed chair.
Excuse me, who's Fed chair now?
Jerome Powell.
Who was Fed chair during the last president?
Jerome and the lady.
No, Jerome Powell.
Uh-huh.
Right? So it turns out it doesn't really matter who the president is. What matters is who's
didn't Biden appoint Jerome Powell?
Sure. What I'm saying is that it's you can have no say in who he didn't. Jerome Powell wasn't his running mate. Like, you didn't know who he was going to appoint.
Oh, but you appointed the president.
You're figuring it out with the rest of the schlubs out there. You have no
but
idea.
It's his judgment. He's appointing a bunch of people. You're voting for the posse.
Did you hear what Ken just said? They're voting for the person that they think they can control.
Yeah, so you're getting a reflection of the president. Okay, never mind. Voting matters. Let's move on. Voting matters. Voting decides who's going to be the Fed chair. I just didn't know how voting mattered. It matters who the Fed chair is.
Okay.
Who gets appointed. I get it.
What matters more, your Traders Post subscription or who you voted for in your district? Your Traders Post
Traders
subscription.
Post, absolutely.
Vote with your money. Vote with your money. All right, let's finish off what he has to say over here. Anyways, I just wanted to get that point. Let's jump to dispersion. So Cem Karsan has popularized this idea of the Summer of George. Have you heard of this? Have we talked about this at all? I don't think you and I have talked about the Summer of George often. I love his Seinfeld references. I love the Summer of George. And I'm not going to go through it all. If you don't know the details of it, you don't know the details of it, like of what the Summer of George is. But essentially, it's a Seinfeld reference. This idea that George Costanza wanted to have a Summer of George, where he was doing all the things for himself, and it was going to be about him and all that sort of thing. And it ended up being terrible for him. He ended up not doing anything, so much so that his legs atrophied. He ended up in the hospital afterwards. It was just a whole thing. So Summer of George is supposed to be like this potential rally, but ultimately ends in disaster. So we have a Summer of George happening right now as the market creeps up in the midst of multiple wars and tariff uncertainty and inflation still high and the discrepancy between the rich and poor greater than they ever were before. All that happens and the stock market is still grinding higher. Why? Because you have Vanna and charm flows. You have positioning within the market, you have forced buyers within the market, and the sellers aren't there, and it grinds higher and higher and higher and higher and higher. Okay. But those are the indexes. The S&P, the NASDAQ, the indexes. The indexes, S&P 500, let's say, has 500 stocks that make up the S&P 500. And the idea that people generally have is that, well, the index just trades at whatever the net balance is of the 500.
Mm-hmm.
Wrong. What happens is that institutions and even retail traders will buy the index primarily. That'll be the primary holdings. They might have single stock names, but they're buying the index in order to. The idea is to soften, to have that diversification. They're owning broader. They're not betting on Facebook when Google could go up. They don't want to have that idiosyncratic risk, and so they buy the index. But and the index is what's used to hedge, right? If you're going to hedge your portfolio, you hedge against the index. You're not going to hedge against 3 stocks within it, because what if you're wrong? And so what happens is that when you buy and sell the index, well, what happens? That ETF needs to go and buy and sell the underlying, right? The ETF is all the 500. Let's say if the S&P 500 balanced off. So when you buy and sell it, they have to buy and sell the underlying, which means that if the Vanna and charm flows, the market positioning makes it so that the index stays sort of pinned, goes sideways, right? It's stuck at that level. When it goes up too high, it gets sold. When it goes down too much, it gets bought, and it keeps staying sideways. What happens is that if any of the constituents shoot up, then something else has to go down for the index to stay pinned.
It has to?
Yes. In order for the index to be pinned, if some of the assets go up, the ETF has to sell other ones.
Can it just unpin?
You would need a lot of flows. So what happens is that because it's weighted by market cap, so as the asset goes up in value, it goes up 20% in value, the other constituents have to be sold in order to balance off the ETF.
Right.
So they're forced sold, right? Which makes the performance of the one that's higher even more attractive. And so people who are buying individual names will buy the individual name more, because they know that the ETF has to buy that individual name, so it goes up higher than it might normally. And as it goes up higher, they have to further sell. So as you have the asset, the index is pinned, this dispersion happens where the underlying components move away from each other. So you still have volatility. It's just not on the index; it's on the individual assets. Let's just hear what he says. He probably says a little bit better than I do.
Because together they equal the index.
Right.
And so there's this other thing. CEO dies. Guess what? The company, the stock, insane number. Flows of the whole market, particularly if liquidity is that low. And the reason I mentioned the correlation part is this is part of how, other than me anecdotally knowing this, by being able to like seeing it, watching it, being the guy who's buying, selling it, we know this too because of that correlation piece. It is not a coincidence in 125 years to have two things that are almost equivalent outliers in history. Right? So we had a 30% lower vol for the reason I mentioned in the indexes, but it was in the indexes. It was in the S&P 500 that vol compression was happening. The single list stocks were not the place where the vol was compressed. And you still had idiosyncratic risk. What do I mean by idiosyncratic? You still had, like, if there's a new cancer drug, guess what? The cancer names are going to go up. If a CEO dies, guess what? The company, the stock will go down. Like, news cycles still would happen. We have a historical range to how single stocks would move and react relative to news. And the only difference between single stocks who are generally moving at their historical range, right, and the index being pinned, right? By definition, the index is pinned and certain things are going one way. This is counterintuitive, but by arbitrage constraints, if the market's not going to move and certain stocks are going to go up, that means other stocks have to go down because together they equal the index.
Right.
Right. And so there's this other thing that happens during summer Georgia, which is another nuance, which is very important, which is a thing called dispersion.
That's right.
And that's what this is. This is dispersion, right? And so what that means is the vol is very compressed at the index level. It doesn't mean all stocks are compressed in terms of their volatility. And so what we actually see during summers of Georgia increasingly is massive correlation breakdown. And what that ironically means is that things are moving more away from each other. So you see massive rotations in the market. And implied volatility of the single names actually can go up while the index is going down.
So this is where you can get trade ideas. This is why it's so important, depending on how you're trading. So let's say you are a swing trader, and you're trading single name stocks, but you're doing it over several weeks or so. Well, you have to be prepared with the idea that if a stock moves up, and it's part of an index, it might move up higher than you think. You might want to ride the trend out longer. Or you might want to set up systems that looks for outperformance in some index names and then shorts the other side, the assets within that index that might go down. So you're tracking correlations and you're taking a look to see, are any of those assets going up or down dramatically, and then counting on the correlation breakdown and going on the other stock.
How can you know excuse me, how can you know which thing is correlated to the asset that's going up? Aren't there multiple things in the index?
Yeah, so you might track correlations for yourself. You might track correlations between multiple different stocks within the same sector. Let's say biomedical within that sector, or energy, or whatever it is. And so that if one has good news that makes it go up, you're going to assume that other ones might go down. So you might go long and then short. You might go long that asset, the ones outperforming, and short the rest of the index.
Do you look at the history and you see what had that effect, and then you've identified what that correlation is by looking at the?
It depends. You might be the guy who's trying to front run it. So maybe you're anticipating news that's going to come out in this sector. So you might buy options on the names that are that's most likely to go up, expecting it, but the options might be priced in such a way that it's expecting a 5% move up, but you're buying the options at 8% because those guys are priced low because they're not expecting an 8% move. But because of this dispersion, that 5% gets outperformed and gets chased up to 8% because the other assets are being sold. That's a simple way of going about it, but there's all kinds of different ways you can take advantage of this. What I like is for, if you're a scalper and you're not even thinking about any of that, the idea is that if you're in a trend and it's going well, maybe leave some on the table, expecting that it might go further. Maybe take a strike that's one further out if you're buying options or whatever it is. So interesting in that way. The last thing I want to mention over here from the Cem Karsan thing before we have to start wrapping up is the institution short versus retail long. Let's just take a look at this. It's very, very interesting.
That's exactly what we're seeing now. So that means there's less liquidity when compresses the market itself.
So he's going to be talking here about the dynamics of what kind of positioning you see at the end of the summer of George, at the tops of markets. What are the characteristics that you see?
And so we're at a higher range than maybe you were last year or in other periods prior, which still allows for some movement. And that's as a function of the macro headwinds and the bigger issues that we had that have led to the initial decline. So, but what tends to happen is shorts are hard by definition. And why are they hard? Because at the end of the day, if entities who need to track the S&P are underweight or institutions are short, that means there's less supply, right, in markets. And it tends to be that retail and more kind of consistent longs and flows squeeze those institutions during some part before the final decline finally comes. And this is why you tend to see institutional shorts and retail longs, in the last part of the rally. Take a look. That's exactly what we're seeing now.
So that's the idea there is that you can have the institutions are placed short because they're anticipating the end of the cycle or liquidity issues or whatever. So they're preemptively short. And the retails are long because they were the exit liquidity anyway. Mm-hmm. But the retail traders are continuing, or the buyback flows are continuing to stay there. Staying short is way harder than it is to be long. And so what happens is that you can get this, he describes it later on in the video, this idea that some institutions will sell calls. Will sell calls above. They're betting that the market won't go up higher. So they're trying to collect that premium by selling calls, saying, the market's going up, but it's not going to go up higher than here. Then the retail traders and the buy flows stay there long enough, or stronger than they realize, which causes the institutions they have to cover their positions. They cover their positions, the price goes up, and because they sold the calls, now they're underwater. In a convex way, they're losing even more as the stock market goes up. Their short positions, not the short positions, but their short calls, they have to buy back these calls that keep going up in value because options go up in a convex way. So then they have to buy back at even higher prices. So you can get this squeeze blow off. That looks like, oh my God, we're going to rally, but that's just enough to where all the longs are now in, all the shorts cover, and where do you go from there? Now you go over.
Oh my God.
And he goes, where we're positioned right now, he goes, that's what we're seeing right now. We're seeing institutional shorts they can't be short really anymore. And the longs just pushing it, but there's only so much that it can be long. And once that peters out, but when you go down, because the vol is compressed, I just love this. You guys got to watch the whole video. Because the vol is compressed, the puts that you would normally buy in order to monetize a downside, options only go up dramatically in value when the volatility is high, right? The option, what you're buying is the volatility, not the price of the asset, not how much it's moved. It's how quickly it's done. What's the volatility of it? And so if the volatility still stays compressed, even as the price comes down, you can have a market down, vol down event, which means puts are not being monetized. Right? You're not getting the jet fuel down where people go, oh my God, these puts are so they're paying out. Let's jump into the puts. Mm-hmm. Because you're paying this high premium for this, you're paying this premium that's not paying out. And so you can get this, not a crash of the market, but a slow step down that just keeps going and going and going and going and going. And you're like, what is going on? I can't monetize the down the way that I normally do. What am I supposed to do? So they're just selling the position and selling the position and selling the position and selling the position and selling the position. And so the way you make money, and he describes a bit of this. He goes, it's zero DTEs. Zero DTEs, zero data expiration options have the most amount of gamma being the rate of change of how much the value of the option increases with every dollar instead of the underlying asset. And so I should say that in a different way. The option, if a stock is $100 and it goes down $90 and you just shorted that stock, you shorted $100 and you buy it back at $90, you make $10, right?
Mm-hmm.
That's it. You don't make any more than that. That's the difference. But for an option, if the stock goes from $100 to $90, depending on how fast that happens and what period of time, you might make more money the faster it goes. Because if it drops fast, then somebody might be like nervous that it keeps on going down, and they'll pay a premium, a higher amount to get that insurance policy from you now. Whereas if it just bleeds slowly to 90, then they're not afraid, they're not going to panic buy. And if it goes instead from 100 to 90, it goes from 100 to 70, right? That option is worth more now than if it went from. It's not the 100 to 10 that you're getting again and again. It's not multiple. It's going up even higher in value because now that the price went down so much further than your strike, more people want that option. And so you have this convexity. Okay, so if you don't get that, so you can get that convexity on zero DTE options because the option is you're paying the least amount for the premium for that, because the option only exists for a certain period of time, only for a certain period of time. And the longer the period is therefore, you can imagine the higher the price for the option, because you're like, well, this option expires next year, where you're paying a certain amount to be able to hold that year. But if the option expires in a month, then you pay even less because you only have it for less. And if the option expires today at 3, you're paying the least you can. But ironically, at the same time, if the price does move dramatically in that window of time, then the need for that options contract, that insurance policy, is so high compared to the price that you paid for it that you can make hella money.
Yeah, but
because
it's
you
high
bought it
risk.
on the day. It's high risk but low cost.
Yeah, but it's like buying a lottery ticket, low cost, high risk.
No, it's not like buying a lottery ticket. If the lottery is going to happen, they're going to pull the lottery next week. Whether you buy the lottery ticket today or buy the lottery ticket the day of the lottery, your lottery ticket costs the same. But if that lottery ticket costs you less and less and less and less and less as you got to that date, then it wouldn't make any sense for you to buy the lottery ticket now. You should always buy the lottery ticket on the day of the lottery.
Okay, so it's not like a lottery ticket, but it is like gambling.
Well, when you're gambling, you're always putting up the same amount of risk. This is the part I'm trying to explain. If you go and you're playing blackjack and it's a $20 table, it's $20 per hand for the same amount of gain. Like, you know what gain you might have, right?
Yeah.
But what if you're at the blackjack table and it's $20 if put your card on, it's $20 now, but as you wait, if you kept waiting, you didn't put your thing in, if you wait, then it's $19, $17, $10, $5, $2, $1, 3 pennies, whatever, and you still get the same amount of payout, then you should wait the most amount of time before you put your bet down.
If you're expecting that event to happen that day, the super fast panic and the panic at
Correct.
the disco.
Yeah, but what's better? You're buying an option, you're paying $1,000 for this option, you have a month for it to happen, and you're bleeding the cost of this option. This option today is worth $1,000 when you buy it. Tomorrow is worth $950. The next day is worth $900, and it keeps going down in value all the way to the thing. And you expect that your payout might be $200 on top of that, $1,200 on this option. So you're paying $1,000 down to make $1,200, or let's call it double. Let's call it, you think you get double your money back. You think you can get $2,000, and it's bleeding out. Then it fails, and then the next month you have to buy it again, $1,000 again. Or is it better to, at the end of every day, pay a fraction of that for today's option? Because if it does drop today, you make gangbusters money. You make $10,000.
I hear you. Makes
So
sense.
it's more risk, but you get to control the risk of how much you want to spend on that option. So you might
Yes,
say, okay,
but-
I'm only going to do it on Fridays and cut down your costs dramatically.
Yeah, but from what I've noticed, the people look, just my perspective, the people who trade have a gambler's heart, and they might.
Not all traders.
I didn't say all traders, but there is a gambling.
If you're a
mentality.
gambler, then you're screwed anyway. If you're a gambler, you're screwed no
That's a
matter
good
where
way
you
of
are.
putting it. Yeah, I get that.
Yeah.
All right.
We're talking about people who understand what they're doing, understand what they're buying. Guys, that's been fun. Those are the big stories. Before we move on to our market minutes, I do want to get a word from our sponsors.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. Traders Post lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Tradeovate, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, Traders Post handles it. It's built to grow with you. Start your free trial at traderspost.io. Trade smarter, automate your edge.
Well, before we wrap up for the day, we talked about some of the big news, the flows, the liquidity, all kinds of good stuff. But there's some small stuff that happened within the markets. Well, smaller stuff that we should take a look at. Top of the docket, U.S.-China deal signed. The U.S. and China signed a trade deal on June 27th, 2025, with China agreeing to speed up commitments, lifting stocks like Boeing and Caterpillar with high public and X interest.
That's good news.
Yeah. Trump ends Canada trade talks. President Trump's decision to end trade talks with Canada sparked volatility, pairing stock gains and pressuring the U.S. dollar with heated X discussions on tariff impacts. PCE inflation remains benign. The U.S. Commerce Department reported a 0.1% PCE price index gain for May, signaling low inflation and supporting expectations for Fed rate cuts, boosting bond and stock markets. Because if inflation is low, then the Fed really doesn't have any reason not to cut rates, right? If reasons show up for them to have to cut rates. Crypto gains on institutional adoption. This is actually the other story I didn't get the time to get to because I thought this was far more important. But news of U.S. mortgage giants Fannie Mae and Freddie Mac exploring digital assets as reserves drove Bitcoin and Ethereum higher with strong extraction amongst crypto investors. I don't know if you heard about this, Peter, but the government institutions, Fannie Mae and Freddie Mac, whose raison d'être is to help Americans afford houses, have been requested, forced to consider crypto as part of the assets for the individual.
Look,
So
you
if they
do
had
that.
50% of their,
Go ahead.
if they had 50% of their wealth in crypto, if they wanted to buy that house, maybe they would have to sell that crypto in order to qualify. But now it looks like it's just in talks right now. They're just looking to consider change the rules. We don't know yet, but it looks like they're being pretty much compelled by the administration. Hey, crypto is real. Mark the market. Consider that as part of their assets.
They should make it so that you can pay your taxes, and that's it. It's game over. You can pay your
Sure.
taxes in crypto.
Just end the US dollar while we're at it. Makes sense. Mortgage rates continue to decline. Mortgage rates eased further, spurring a rally in real estate stocks and REITs like Simon Property Group with steady X interest in housing market recovery. U.S. dollar rallies on trade optimism. The U.S. dollar strengthened amid positive trade deal news and J.P. Morgan's robust 2025 growth outlook, affecting Forex markets and garnering some X attention. And tech stocks face tariff volatility. Trump's tariff headlines caused intraday volatility in tech stocks like Microsoft and Amazon. Actually, I think Microsoft laid off, 17,000 people? I think that's what it was. The stock didn't really take a hit, but that was pretty interesting. And finally, Coinbase rises on regulatory hopes. Coinbase stock gain on optimism for a stablecoin bill, boosting crypto-related equities and generating buzz online. Peter, between Circle, the stablecoin ETF, and Coinbase, I mean, those guys are leaving Bitcoin in the dust. They're just smoking everything. They're acting just like meme stocks. We don't have time today to go through a whole analysis of what's going on in crypto, but if this is any signs, 150,000 on Bitcoin is definitely still in the cards. I know I've been calling for it to happen like by now or by like the 30th. That was what my Polymarket bet was all about. But to be fair, Iran did get bombed by 2 countries. To be fair.
Look, you're the one who told me you don't know what tail events will happen, but you can be damn sure something's going to happen. You also told me the market is always seeking to cause the most amount of pain to the most number of people. So there you go.
That's right.
Take
Especially me.
Especially you. I think the market has that out for you for sure.
All right, guys. Well, this has been fun. This has been After Hours. We'll be back next Friday, 4 p.m. Eastern Standard Time for even more market commentary. It won't be as Cem Karsan heavy. I'm sorry.
You don't know that.
I know every episode should be Cem Karsan worthy. No, every video he puts out, I watch, and he crawled out of his hole, and that's why I got this one. Normally, he's too busy making money to deal with the likes of us. And his tweets are way too cryptic for me to be able to make heads or tails out of it. Even Grok has some difficulty with it. Any case, you guys want to go check out the video? I'll be posting the video for this and Darius Dale's inside of the comments. You guys want to check that out? Head over to X, message them, say, hey, I heard about you guys on After Hours. Fantastic. Why haven't you guys been on After Hours yet? Are you guys scared of hard questions? Are you guys scared of undiluted praise? What's going on? Traders Posts, as always, we're going to be here on Tuesdays at 3 o'clock for office hours. You get the peek behind the scenes of developing the platform, new features, and how people are thinking about developing automated trading strategies. And on Thursdays, we do Blueprint, which are walkthroughs and tutorials about coming up with strategies and indicators and tool sets, all the things we've been talking about. Why? Because Traders Post wants you to be the best trader you can be. Because the more money you make, the longer you pay your Traders Post bills. There, we said it. Your success is our success.
That's right. That's the only person you can trust is somebody who has an interest in your success, and clearly Traders Post does.
Exactly. Perfect. All right, so we'll see you next week, and don't forget, your vote doesn't matter. Just it doesn't matter.
Please vote and subscribe.
Please vote.